European stocks and US futures fall after Jay Powell says there is no hurry to cut rates. Pharma stocks slip after Donald Trump selects vaccine skeptic Robert F. Kennedy Jr. for health secretary. There's no room, though, for JP Morgan CEO Jamie Dimon. Plus, Chinese retail sales grow at the strongest pace in 8 months as signs emerge that Beijing's stimulus efforts are paying off. Let's check in on markets then. European markets under pressure once again. You are set, at least at this stage, for 3 straight weeks of losses across the European equity space. The FTSE 100 is flat. On the downside, when it comes to your sectors, the biggest losses coming through from, yes, healthcare as a result of that appointment, or at least tapping up of JFK Jr. for that key role of Secretary of State for Health. Over in France, the CAC 40 is off by 0.2%. You're seeing similar losses over in Germany. The IBEX, though, in Spain is just holding on to gains of 0.5%, and you're modestly higher on the FTSE MIB as well. But again, broadly across the European benchmark, you are seeing losses once again risk off. And part of that is down to what we've been hearing from Jay Powell. 50-50 now, it seems, in terms of whether or not they go again in December. That's the market expectation. Powell sounded, to some at least, a little bit more hawkish yesterday, talking about the strength of that US economy. S&P futures then, after losses of about 0.6 yesterday, looking at a similar picture again today. Looking for the next catalyst, it seems, for US equities. You saw yields up on the back of that speech from Powell today. There's a little bit of a bid at the front end, at least 4.32 on the 2-year. Yields just down 2 basis points. Euro dollar at 105. The pound as well in focus on the back of softer economic growth than had been expected in the third quarter here in the UK. Brent 71.68, down 1.2% on concerns about a glut in that oil market. The show starting right now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London. European stocks and US futures, as we mentioned, falling following those comments from Jay Powell. The Fed chair says the recent performance of the US economy has been good, indicating there is no rush to cut interest rates.
The economy is not sending any signals that we need to be in a hurry to lower rates. The strength we're currently seeing in the economy gives us the ability to approach our decisions carefully. Ultimately, the path of the policy rate will depend on how the incoming data and the economic outlook evolve.
OK, Jay Powell speaking yesterday, of course, sounding, at least to some, a little more hawkish. Very pleased to say I'm joined now by Melanie Baker, senior economist at Royal London Asset Management and Bloomberg's managing editor for FX Rates, EMEA and US, Rachel Evans. Melanie, let's start with you. Good morning. How has the voicing of some of these Fed officials, the sounding coming through from Jay Powell and others, adjusted your views on where the Fed goes next? Do they cut again in December, or is that now off the cards?
I think it's neither. I think it's I'm sort of a little bit on the fence on this one. So I think after the press conference last week, it already felt to me as if they were kind of trying to prepare the market a little bit for a potential pause. And I think we've had that again and enhanced in a way from Powell last night. I wouldn't see this as anything more than a potential skip, or just allowing them, if they feel it's necessary, to sort of slow the pace at this point. But yeah, definite kind of change in tone, I think.
A changing tone. As you project into 2025 then, Melanie, markets now expecting fewer than 2 rate cuts, fewer than 50 basis points between now and June of next year. Does that align with your view in terms of what to expect as we look into 2025 for the Federal Reserve?
It's not far off. It's probably a little bit less in terms of rate cuts than I'd have. I'm still inclined to think that maybe next year we get 3 to 4 rate cuts, but there's a lot in the balance right now. I mean, the economy is performing really quite well. The labour market is relatively solid if you can look through that October number, of course. And on the inflation front, just things a bit less reassuring than they were. And on top of that, of course, we now have a Trump presidency, and the combination of his policy proposals at least looks likely to be inflationary to me.
OK, let's bring in Rachel at this point then for the markets view and how markets have adjusted. It's been a choppy week again in terms of how markets are priced around the December meeting for the Federal Reserve. How much of that is priced in right now across the Treasury curve, and how much more work is to be done?
Yeah, I think it's a good question because we've been having these kind of different buffeting factors for the bond market in recent weeks. We obviously had the Trump trade, which has been pushing up yields. That seems to have eased a little bit, and people have been focusing more now again on monetary policy in the wake of those Powell comments. We've really seen yields backing up quite a long way, though, as a result of kind of those two different impulses. We're around 4.45% on the 10-year at the moment. That's still up 14 basis points from a week ago. So we've really kind of been continually sort of adding basis points to yields. Yields have been continually rising. So I think there's a question mark about how much further that can go off this idea of a Fed pause or a Fed skip. I mean, we've got to remember that, kind of in September, we saw the dot plot suggesting that the Fed would cut 3 times this year. They obviously went big in September, and then again in November. So maybe they can hold off on December and push that to January. But there is some expectation that we might see, a cut still coming in December. It's about 60% priced at the moment.
OK, so if they do hold in December then, Rachel, does that push yields up to are we getting closer to that 5% level? Because then, of course, we have to think about the interlinkages between yields and an equity market that is still in bull market territory, even if there's been a bit of a pause in the last 48 hours.
Yeah, and the Fed doesn't have a mandate, of course, to worry about the stock market and stock market performance, but they don't like to see too much volatility or instability coming through to markets. So the impact of higher yields kind of spreading through to equities is going to be something that's on their radar, even if it's not necessarily motivating their decisions. And I think to your point about kind of, where do we see yields sort of heading back to, 5% is very much now within, people's bingo card about what could be next on the agenda. Whether we get that this year, I think maybe that would be a little premature. We need to see kind of, whether we do get that pause. And also, I think a lot of the move up in yields has been predicated on this idea that Trump will be inflationary in his fiscal policy. We obviously know now that he has Congress as well. That's something that, again, favours higher yields. We don't yet know the detail of the policy. So we may need to wait till we get the inauguration and we get some of those policies laid out for that kind of leg higher up towards 5% to really play out.
Yeah, and you speak to that uncertainty in terms of what policy is prioritised and in what time frame it's enacted as well, and how the markets have to think about that. With the 10-year right now stateside at 4.45, yields essentially flat on the session today when it comes to that main benchmark. Melanie, let's bring you back in, but switch focus to what's happening here in the UK, because of course we had a weaker GDP print for the quarter, the most recent quarter, the third quarter, and again, a reminder of just the challenges for this UK economy. Does it change? Does it move the dial again for particularly when it comes to hawks at the MPC, who have kind of been pushing this line that they need to be still pretty restrictive when it comes to rates because of those inflationary risks?
Yeah, I don't think it does. I think the inflation data next week is going to be much more important for those hawks. What they want to do, to be able to do, is worry less about inflation persistence. So I think it's going to be more from that perspective, watching the inflation data and watching the wage data. I think if you look under the surface of today's GDP figures, they weren't actually quite as weak as they look on the surface either. So again, I don't think today's data is a game changer.
OK, not a game changer yet for the BOE. Markets pricing in, I think, 2 cuts between now and August for the Central Bank of the UK. Let's get back to the US politics then, because, of course, as Rachel and you both are kind of been pointing to, it's the uncertainty there, and at least the details coming through, that is having to be factored in by markets as well, particularly on the kind of inflationary impulse. But stock-specific, sector-specific, certainly today, with another controversial nomination by the US President-elect Donald Trump, who has tapped Robert F. Kennedy Jr., a prominent vaccine skeptic and critic of Big Pharma, to run the Department of Health and Human Services. Let's bring in Bloomberg's senior writer, Stephanie Baker, who's been looking at some of these new appointments. Stephanie, are we getting kind of voodoo medicine, voodoo health coming through for, a voodoo doctor, essentially? Is that the critique that's been labelled at this appointment, what it means for the health of US citizens?
Well, he's famous for being a vaccine skeptic. He's talked about removing fluoride from the water, traditionally a local issue in the United States. But his pick will be very controversial. It's unclear whether he'll get through Senate confirmation. He has to go through 2 committees, Senate Finance as well as Senate Health, because the department he's picked to oversee runs Medicare and Medicaid, these huge budgets. I think that these appointments signal this is not just about loyalty, it's not just about disruption, it's not just about daring the Senate to defy Trump after he swept them to a victory, but he's embarking on a revolution in the United States. He's choosing people that have vowed to blow up the very departments and agencies they are chosen to run. So I think, it remains to be seen whether or not these picks can get through, whether or not the Senate, actually does its job and demands a full hearing and enough senators, Republican senators, vote to oppose some of his more controversial picks.
OK, so that's still a question mark, clearly, in terms of whether or not he gets that final sign-off. But again, as you say, could be revolutionary in terms of how these government departments are treated under some of these names, if indeed they get confirmed. When it comes to the Treasury Secretary, we're still waiting for that announcement. Someone who we can rule out is Jamie Dimon, the CEO of JP Morgan. Let's take a listen to what Jamie Dimon had to say when he found out and was asked about the fact that he was now not going to be part of this Trump administration.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start.
OK, Jamie Dimon speaking at the APEC CEO Summit in Peru. And for context, of course, Jamie Dimon had not been asking for a role in the Trump administration, but of course he is a name that many people have pointed to over the years as someone who could potentially have political aspirations. What do you make of what we've heard from Jamie Dimon, what we've heard from Trump in terms of the message he put out around the CEO of JP Morgan, and what it tells us about who is likely to be the Treasury Secretary?
Well, the leading candidate that most people think is going to be picked is Scott Bessent, a hedge fund manager from Florida. But I've heard some of the speculation that maybe his support is being undermined from people talking about his past work for Soros Fund Management. As we know, there's no love lost between Trump and George Soros. So whether or not that will he will actually be the pick that gets through. I've heard Howard Lutnick is another one that, was potentially in the running. So it remains to be seen. That's the last big one, I think, for him to name.
OK, that's what we're waiting for. The Treasury Secretary, at least the nominee, who's going to be tapped for that role. Stephanie Baker, thank you very much indeed for the latest names that have come through in terms of some of these potential nominees to the incoming Trump administration. Talking of which, let's get back to what's happening in terms of European pharma, because that sector has been the worst hit on the back of this news that Donald Trump's choice to run the health department in the US is going to be Robert Kennedy Jr. Again, he has to get through that confirmation process to run Health and Human Services Department stateside. Let's bring in Joe Easton then for a check on the equity market moves around the tapping up of JFK Jr. What are we seeing, Joe?
So we're seeing some significant declines in these vaccine stocks today, Tom. Take a look at Sanofi, known for its respiratory vaccines, and also Glaxine, which does a big business in vaccines for shingles. Both of those seeing significant declines. Down 3% almost for Sanofi. Glaxo coming up a little bit, was down around 4%. And the other vaccine makers, Alka, Bello and Bavarian Nordic, which coincidentally had its earnings out today, hit by this news. But this isn't just about vaccines. It's broader healthcare as well, because Trump wrote on a post on X that the industry has been subject to misinformation, slamming the American consumer of pharmaceuticals, according to his post on Twitter or X. And therefore, we're seeing losses in any company, really, that's exposed to the US healthcare sector, including over in Switzerland. Take a look at Roche on the screen here, down 2.4%. Novartis, the rival there. Novo Nordisk, Europe's biggest pharmaceutical company. And AstraZeneca here in London as well, down almost 3%. And as such, healthcare by far the worst performing sector in Europe today. In terms of the sector breakdown, we can see it right down the bottom there, down 2%, underperforming the main market, which is down just 0.4%. Clearly, RFK's appointment spurring fear in the market for healthcare stocks today, Tom.
Joe Easton, excellent wrap of the equity market moves with that focus on healthcare. Thank you very much indeed from our equities team, of course. Coming up, China reporting better than expected retail sales. We're going to take a look at what that means for signs of potentially an economic turnaround. Is the consumer of China feeling a little bit more optimistic? That is next. This is Bloomberg. Welcome back. Happy Friday. Now, China's economy showed signs of stabilisation in October, buoyed by better than expected retail sales. Let's get more then from our senior Chinese economy and government reporter, James Mager, staying late for us in Beijing. James, how strong is this data? Will it be sustained? Is this the turnaround we've been looking for?
It's too early to say whether this is the real turnaround. I mean, obviously, retail sales was a lot stronger than expected. And part of that is because in October, you had a long holiday. So a lot of people went away, went traveling. and spend a lot more. You also had the Singles Day promotion started earlier this year, which is actually a online shopping festival in November, but there was a lot of discounts online available in October as well. And then the government has also been handing out, local governments have been handing out consumption vouchers, so you can buy new toasters and fridges and that kind of thing. So those things all boosted retail sales to a record 4.5 trillion yuan in October. But, we're going to have to see whether that continues into November and December, or whether this is a one-off boosted by those factors. And I think if you look at the industrial side of the economy, there was a slowdown there, but actually it wasn't slow enough to sort of really solve some of the problems of overcapacity that Chinese industry is facing. Steel rebounded, copper rebounded, cement and glass fell, but not as much as you probably would expect, considering the housing market is still in the doldrums. So, this is a better month than we've seen for quite a while, and obviously some of the stimulus and some of the the things that the PBSC and other government departments have done has helped the housing market a little bit. But we'll have to see whether this extends beyond this October through the end of the year and into next year.
Well, James, on that question then, what is the assessment of you and the team sitting there, poring through the data with a finger on the pulse of this economy, in terms of what it does, in terms of moving the dial around some of those key challenges and problems that are facing that Chinese economy? Are we starting to make some headway?
You're starting to see some signs of life in the housing sector. There was a pickup of sales in October, but so the real problems of overcapacity that were caused by the collapse of the housing sector, those are still to be dealt with. So you still have massive overproduction of steel, and that is flooding out into the global market. You're seeing record or almost record steel exports again, to the biggest since 2016, and that's really not being dealt with fast enough to stop that that flooding out overseas. There's still a lot of weakness in the retail economy. Growth rates are much lower than they were before the pandemic. You wander around Beijing, and there's lots of shops and restaurants that are shutting down or that have closed. You go to department stores, shopping centers, and there's lots of empty stores. So, the sign now is of possible start of a recovery. But even the things that the government has announced so far are much more long-term and mid-term plans to fix things like government finances, to fix things like over-indebtedness in the government sector. But that's not going to provide a boost to consumption right now. And so, unless the things we saw in the October data today continue, it's still going to be quite a long haul, I think, for the broader economy.
OK, so still some question marks as to whether or not this is a sustained turnaround that we're starting to see. Some mixed data then coming through out of China, with a breakdown there and the context coming through from James Mager, joining us live from Beijing. Let's get back to Melanie Baker from Royal London Asset Management right now. Melanie, I want to question to you then on China. Is 2025 the year, do you think, when China can engineer a turnaround?
Oh, that's a big question, isn't it? I'm definitely more optimistic than I was, right? We have seen a change from policymakers, a big step up in stimulus. But what you're not seeing, as has just been talked about, are measures that are really going to boost consumer spending directly over the next 12 months as of yet. And then you've still got sort of significant longer term problems in China, particularly around population growth, that really constrain, I think, China's longer term growth rate.
OK, Melanie Baker from Royal London Asset Management. Still not convinced that China can turn things around. Still a lot to watch there. Uncertainty. Thank you very much indeed, again, for giving that economic lens to what we're seeing in terms of adjustments around expectations for the Fed, the BOE and China, and the support that's coming through on the back of that data. Melanie Baker, Senior Economist at Royal London Asset Management. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. Happy Friday. We're going to check pre-market on Domino's Pizza because Berkshire Hathaway has bought stock in the company. Buffett's Buffet taking a slice of this company. 3.6% slice of Domino's Pizza, valued at about $550 million. The stock, as you can see, is up 8% on the back of that, and I will not apologise for the cheesy puns. Right, here's what else you need to know this morning. The US Federal Trade Commission is reportedly set to investigate anti-competitive practices at Microsoft's cloud computing business. The FT says the regulator is looking into allegations that Microsoft is blocking customers from moving data from its Azure cloud service to rival platforms. The report says tactics include exit fees and punitive licensing terms. EU regulators have fined Meta nearly €800 million for tying its Facebook Marketplace classifieds service to the social network. The European Commission also ordered Meta to refrain from imposing unfair trading conditions on rival platforms for second-hand goods. It's one of the final acts for EU antitrust chief Marguerite Vestager, who is set to leave her post before the end of this year. Coming up, after the UK Chancellor said the crackdown on banks in the wake of the global financial crisis went too far, we're going to speak to Nigel Wilson, former Chief Executive and Legal and General Chairman of Canary Wharf Group, for his views on what we've been hearing from the UK Chancellor and some of those pension sector changes that are now in the pipeline. That conversation's coming up next. This is Bloomberg. Good morning, welcome to The Pulse. I'm Tom McKenzie in London. Happy Friday. These are your top stories. European stocks and US futures fall after Jay Powell says there is no hurry to cut rates. Pharma stocks slip after Donald Trump selects vaccine skeptic Robert F. Kennedy Jr. for health secretary. But there's no room for JP Morgan CEO Jamie Dimon. Plus, Chinese retail sales grow at the strongest pace in 8 months as signs emerge that Beijing's stimulus efforts are possibly paying off. To the UK now. The UK Chancellor says the crackdown on banks in the wake of the global financial crisis has gone too far, vowing to ensure regulations focus on growing the economy. This comes as the government attempts to win back the business community following criticism, of course, of last month's budget.
It was right that successive governments made regulatory changes after the global financial crisis to ensure that regulation kept pace with the global economy of the time. But it is important that we learn the lessons of the past. These changes have resulted in a system which sought to eliminate risk-taking. That has gone too far. And in places, it has had unintended consequences that we must now address.
OK, joining us now is Nigel Wilson, Chairman of Canary Wharf Group and former Chief Executive of Legal and General. Nigel, do you welcome the comments from the Chancellor around regulators maybe going a little too far in trying to contain risk?
I absolutely agree with what you said, because it's the truth. We've been over-regulated with excessively risk-averse regulators, not just in financial services, but I would say in every industry in the UK.
How far, I guess the question is then, how far should this government go in re-injecting risk? And are we ready, the body politic of the UK, the people, the consumers of the UK, ready for that additional risk?
But if you're at negative risk, in a sense, what you've been doing has resulted in very poor outcomes, and you want to do something that's going to deliver much better outcomes. And I'll take example. Various asset classes are often very difficult to get approved by the regulators for getting appropriate capital treatment under a reasonable time frame. So you end up investing in the US equivalent of them instead of investing in the UK. And that's not a good outcome. We just don't invest in the asset class because the regulator hasn't approved it in the UK. That's just total risk aversion, and it results in terrible outcomes and no UK growth. If we're now going to speed up the method by which the regulator approves new asset classes and the capital required underlying those assets, that will make us much more competitive as a country.
Are there specific measures you would like to see this government put in place to constrain regulators and to inject a little bit more risk then? How far specifically, what do you think the policy prescription should be at this point?
I think the regulators realise that they've made errors themselves, whether that's the water industry, the telecom industry, the food and drink industry.
Motor financing right now is a potential issue brewing for UK banks?
Well, and it is an issue, and it's got to be resolved. And it's an old issue that's going to cause further problems. But as a country, we're bottom of the G7 every year in terms of investment. And a lot of that to do is with excessive risk aversion within the regulators. This has to change, because we've got all the capital. We've got $6 trillion of long-term capital. It's hopelessly misallocated and has very little risk in it compared to the US equivalent. And if the US have got it right and we've got it wrong, and they're going to grow faster and they're delivering, much higher returns in the US than the UK, we've got to learn from the lessons of the US and try and transfer them over here. Take the best of the US, transfer them, and actually start competing on at least an even keel from a regulatory point of view.
When it comes to the pension changes, the other significant announcement that came through from this Mansion House speech from the UK Chancellor, it seems they are drawing lessons from the US, from Australia, from Canada, with the push for mega funds that will be legislated. Is this just the opening gambit? How far do you think this should go? How consequential do you think it will be, essentially?
It's just the opening gambit. I think because we've been, again, excessively risk-averse in what pensions have invested in. Essentially DB schemes are in cash and gilts, and even DC schemes. We've got to get them somehow to allocate some of their capital to UK infrastructure investment and UK growth companies. And personally, I would use soft compulsion, say actually the target amount for that is 5%, and the target for infrastructure and the target amount is 2%. Those are not wildly radical numbers, but if you're talking about a fund which is going to be 800 billion or a trillion in terms of DC, those are large amount of numbers that would make a difference here in the UK. We have 300 billion in cash ISAs in the UK. We're the only country in the world that gives a tax benefit for investing in cash. Imagine if that 300 billion was invested in higher earning, higher performing, brackets, more risky assets over a 1-year VAR period, but over a 10 or 20-year period. Absolutely lower risk than actually investing in cash over that period.
Yeah, and to be clear, DC, defined contribution and defined benefit pensions. How far do you... At this point, we're just looking at local governments being pulled in terms of their pension funds. Yeah. When does it expand? What is the time frame that you're hearing about when that expands?
They want to get on with it. The first thing is, that unlike the budget, which was an ideological budget, this is actually a discussion about growth and a growth agenda, which is great to hear. So the direction of travel is actually right. I talked to the Treasury afterwards, and they tell me, yes, we're really going to crack on with this, and we're going to get legislation approved early next year and really begin to make a difference. But it's a necessary condition, not a sufficient condition through growth. This in its own right will, as we talked earlier, LGPS used to own, which is the local government pension scheme, almost 40% of their assets were in UK equities. Now it's less than 10%. And we've had a lot of consolidation already, and consolidation resulted in less investment in UK equities rather than more. OK, so do you think the legislation gets through, or they start to draft it and push it through next year? March or April next year. March or April next year, but when do they move on and expand this? Are they accelerating on expanding this to the private sector? They will accelerate this. I'm absolutely... Because they have to. If they want a growth agenda, they've got to have growth capital in the UK. And at the moment... everybody in a business point of view is on the back foot as a consequence of the budget, and that's not a good first step for the government. You described that just now as an ideological budget. Yes. What do you mean? Was that an anti-growth budget? That was an anti-growth budget, but it was actually, I would say, traditional Labour. Let's sort out the health system. It's very much what they did in 2020. But the situation with 2020 was very different, where Gordon Brown and Tony Blair inherited... in 1997, inherited from the Tory government an economy that was growing at 4%, and they had a budget surplus for the next 2 or 3 years. So you could massively increase spend in health. This time, you had to look for the offsetting tax to pay for that, and that was very painful. And that was very painful. Did they lose some of the business community on the back of that budget? I think they lost some of the business community on the back of that, because it would have been better if Rachel had done them the other way around, actually had the pro-growth, reducing regulation, consolidation. We're going to make pensions a source of capital for growth in the UK, and then done the budget. So you talked about some caps that you would want to introduce. Well, some guidelines. Guidelines, okay. Guidelines on soft compulsion. These are the targets that we should be aiming for. But you've made it pretty... I mean, it's pretty stark, the numbers, the stats, in terms of the lack of investment in UK assets, historically, or at least where we've come from since the 1990s, early 2000s. Yes. And you called it shocking. Do you think at some point there's going to have to be a mandate to invest in UK assets? Yes. Yes, I've been in favour of mandation for about 15 years. Because there's a lot of pushback to that. There's a lot of pushback to that, but there was a lot of pushback to auto-enrolled DC pensions when they first came in, and they were soft compulsion. You had to opt out of the pension scheme, not opt into it, and that was a good thing to do. And we again were at the centre of that, and there was a price cap introduced for that to actually drive growth in those sectors. And Steve Webb, was a very radical pensions minister, and he really made a difference. And the reason we're heading towards £1 trillion in DC pensions is because we were bold.
How vulnerable, before we let you go, Nigel, because of your deep experience in the UK business environment, how vulnerable do you think UK PLC is to an incoming Trump administration?
No, I think one of the things that's going to happen is Trump's going to cause a catalyst across Europe for Europe to start working together. And actually one of the offsets is going to be actually Europe, which is in a mess. I mean, you were talking earlier about no growth in Germany, no growth in France, no growth in Italy, Spain, minor amount of growth, a few of the smaller countries doing okay. And actually we need a growth agenda for the whole of Europe. Trump's going to make that more difficult, and therefore, hopefully, we'll get to cooperate more. Keir Starmer's said that, the Governor of the Bank of England has said that, Rachel Reeves has said that. Brexit was a huge mistake, a big mistake. We could rectify it a little bit by getting closer to Europe, and Europe may welcome us much more now, because we're all going to be suffering the pain from Trump.
OK, Nigel Wilson, always appreciate your time. Finger on the pulse, of course, of the UK business.
Thank you.
Environment and sector, of course. Nigel Wilson, chairman of the Canary Wharf Group and former chief executive of Legal and General, on the pension changes and the need for more risk-taking when it comes to the focus on the regulators and how they can change to ensure that there is greater growth in this UK economy. We're going to bring you live pictures right now. Nigel was just talking about the lacklustre growth, if there is any, across Europe. Well, we're going to get some forecasts right now. These are live pictures of the European Commission's autumn forecast press conference in Brussels. You're seeing the European Economy Commissioner Paolo Gentiloni saying the euro area is set for a consumer rebound, but risks are high. We're going to have more with Bloomberg's Oliver Crook, who's listening in with the details, with the context, what we're hearing in terms of some of these renewed forecasts from the European Commission. That's coming up. This is Bloomberg.
Productivity is set to stagnate this year, and it is then expected to post a...
Welcome back. The European Commission says euro area economic growth will pick up next year as obstacles to consumption and investment fade, though geopolitics poses an increasing threat. For more on the numbers out in the last few minutes, Bloomberg's Oliver Crook joins us with quick-fire reaction from Brussels. Talk us through the Commission's report then, Ollie. What have they been saying about the prospects for the Eurozone?
Yeah, so listen, Tom, we should look at kind of the figures that we got, namely out of the GDP and CPI. These are the two figures that people are going to be most sort of concerned with. We can start with growth in terms of what the EU Commission is expecting. What they are expecting in terms of growth for this year is 0.8% growth in the Eurozone. They're expecting that to come up to 1.3% next year, and then into 2026, 1.6%. These are obviously increasing trends. This means that growth is going to rise, though very, very gradually in the Eurozone. These are not particularly encouraging figures, Tom. What we have seen after the pandemic, there was a big boost due in large part to a lot of stimulus that took place. But these numbers that we're getting now out of the sort of Europe in terms of forecast for growth are lower than the trend that we had before the pandemic. So this is hardly sort of hugely reassuring information. They're also saying that basically consumers are going to come back. There's going to be some more spending. They've seen that happening this year. But one thing that they highlight is also going to be less investment. There's going to be a contraction of investment going into the end of this year. This is not an encouraging sign on a number of fronts. On the question of inflation, they expect that inflation across Europe will reach 2% by the fourth quarter of next year, finally hitting that ECB target after that huge sort of inflationary spike that we've been dealing with over the last few years. We should say that that is a bit of a discrepancy from what we've heard from a number of ECB speakers who expect that to hit 2% in the first or second quarter of next year. So we'll ask Paolo Gentiloni about that when he comes on set to talk a little bit about it. But we should also say, Tom, these numbers you've got to take with a huge grain of salt. You have to ask yourself, are these numbers really valuable at all? Because there's so many risks on the horizon that could really impact this.
Yeah, well, there's an elephant in the room, isn't there, when you're talking about some of these numbers and some of these projections, and that elephant is, not to be unkind, but, you know, in terms of policy at least, is Donald Trump and the incoming Trump administration. How vulnerable, then, are these projections to the whims of the incoming US president?
I think they are supremely vulnerable, Tom. I mean, I think that these are probably some of the most vulnerable economic figures we've ever gotten out of this sort of Eurozone in sort of recent times, because we don't know exactly what we're going to get from the Trump administration, but we know we're going to get something. And if it's 10% tariffs, as he's talked about on the campaign trail, or 20% tariffs, I mean, we know what 10% means according to Goldman Sachs. That could hit European growth to the tune of 150 billion euros a year, right? That is the difference between, from the numbers we're getting out of the Eurozone, some growth in Europe and zero growth in Europe, right? There's also the question of how it could bear on inflation. This could be a big driver up in terms of inflation. This is not even to talk about the complexity of the EV tariffs and the own tariffs, the trade war and disputes that are going on between Europe and China, to say nothing of the fact that, of course, when there is a trade war between the U.S. and China, maybe 60% tariffs, according to Donald Trump, all this other capacity from China could also flow into the European market. All of this stuff needs to be sort of discussed and figured out. And I'm very pleased that we're going to be able to talk to Paolo Gentiloni, because we're going to move away from the actual forecast and talk about some of the risks and have they modeled this stuff out, because that is going to be the big question for investors and really for everybody here in Europe.
OK, Bloomberg's Oliver Crook, thank you very much indeed, passing the details that come through from the European Commission. And Ollie will be speaking, as he mentioned, to Paolo Gentiloni, the European Commissioner for the Economy. That's at 10:45 a.m. UK time, so certainly tune in for that interview. And Ollie was talking about the EV sector. We have a different line on that story right now, because Tesla and Rivian have extended their losses after a Reuters report that President-elect Donald Trump is considering dropping a consumer electric vehicle tax credit. Bloomberg's auto czar, Craig Trudell, joins us with the details. How likely is it then, Craig, good morning, that this subsidy, I should say, about a little over $7,000 US, the subsidy ultimately is pulled by Trump and the administration?
I think we can look at the Trump transition team's response to this report as, essentially like, why are you surprised here? They say, Trump ran on this and he's essentially going to keep his promise to the American people. So
some people might say, well, we're surprised because Musk is part of the administration and he could lose out on this.
Yeah, I do think the way that the market has sort of piled into Tesla as a Trump trade, if you will, has been kind of remarkable, because you've seen a sort of rationalization of, well, maybe he'll be able to spare EV tax credits, or maybe he'll kill EV tax credits and that will hurt Tesla but won't hurt them as much as the other guys. And it's kind of all over the place. And I think, sort of the depth of the analysis leaves a lot to be desired. I do think that when you look at who is most affected this just on sheer volume, Tesla is far and away still the biggest seller of EVs in the U.S. They have the most consumers who are eligible for these tax credits. They will be hurt very significantly by this, whether Elon Musk wants to sort of admit it or not on his earnings calls. He has tried to minimize this, but I don't think he's made a very convincing argument for the idea that, this will only just be, a flesh wound.
OK, no, that's really interesting. So you're very clear that Tesla will be impacted by this because, yes, to your point, Musk has come out and said, look, we're better positioned. And he's kind of pushed for removal of these subsidies, which to some would seem counterintuitive. But you don't buy that argument that necessarily Tesla is in a better place than some of its competitors, that it can push back on some of the incumbents and allow it to hold that market share.
I think there's an element of the argument that he's making that does stand to reason. This idea that, we're the only ones actually making any money making these EVs. So we can afford to sort of take this hit and our competitors would be devastated. There's some merit to that, by all means. They are in a much better position in terms of scale and could potentially, be able to withstand this from the perspective of a profitability standpoint. The problem he has is that these other car makers are still selling, 80, 90, 95% or more of their vehicles are combustion engine vehicles, and those are making quite a bit of money. And Tesla doesn't have any of those. And so, Tesla is still, in the sort of grand scheme of things, a small part of the market. It's also the case that Musk, for years now, has been emphasizing we need to make our vehicles more affordable. The reason that we're not growing like we used to is because our cars still aren't affordable enough. So taking away $7,500 from that equation and, in the sort of same breath of making that argument that our cars aren't cheap enough for people, it really doesn't sort of check out.
Particularly after Tesla's pushed through a number of price cuts as well. Is there an impact on European car makers?
I think there absolutely is, in the sense that, on one hand, if you're a Mercedes or a Volkswagen, you can't really pull back on your investments in the U.S., especially with, as you and Ali were talking about, the trade rhetoric and the tariff risk for these companies. You probably also want to be sort of hedged for the idea that after 4 years, are these fuel economy standards that Trump, again, potentially weakens, only going to get stronger again with a next president? You may want to sort of stay the course with the investments that you've already been making as well, and yet the rug's being pulled out from under you here, and so this is a real challenging sort of thing to confront if you're an executive in Stuttgart or Wolfsburg. How the heck do you sort of navigate this near term with a market in the U.S. that has been really all over the place policy-wise the last few years?
Yeah, you can imagine those European executives, heads in hands, saying kind of, what gives? What next?
Do we do
Come
here?
on, this is it. We're already facing a list of challenges, and now we have another one. Craig Trudell, with the context around the reported cut to this subsidy for electric vehicles in the U.S. Bloomberg's car czar, of course, Craig Trudell. Coming up, we're going to break down the latest moves by hedge funds with Warren Buffett's Berkshire Hathaway cutting its position once again in Apple. That is next. This is Bloomberg. Welcome back. Hedge funds have reduced their exposure to tech giants like Amazon and Apple. That's in the third quarter, at least, as the stock market rally broadened beyond big tech. That's according to Bloomberg analysis of the latest data from those 13F filings. Let's bring in Bloomberg's Charlie Wells, who's been poring over some of the numbers. The moves out of big tech, what does it tell us? What's been happening?
That's really interesting. I mean, this is really the moment when we get to look into that kind of time capsule of smart money. So this is all the filings that institutional investors have to make. And as you say, in that third quarter, we really saw them kind of rotate out of big tech. We have analyzed 1,007 of these 13F filings for hedge funds so far. If you think of names like Amazon, holdings there decreased by $11 billion. So that's a big positioning away from there. We saw Warren Buffett's Berkshire Hathaway cut their Apple exposure by 25%. And it's also interesting when you look at some of the pickups, some of the big aggregate gains that a lot of these hedge funds added for some of these names. It's sort of like the new old normal. So you've got like Southwest Airlines, you've got Bank of America that they're picking up. Interestingly, financials were the largest increase in holdings for these hedge funds.
Right, that might have been good timing, given that financials done very well on the back of Trump's election. There's a redhead crossing the line right now from Alibaba, of course, that e-commerce giant in China, with that listing, of course, as ADRs over in the US. Said to be considering an offering of $5 billion of bonds, apparently within dollars, and yuan could come as soon as this month, which reminds us that these hedge funds in the US also have exposure to Chinese stocks. Briefly, what's happening?
Well, it's helpful that you bring this up because Alibaba shows that there's kind of been a shifting play in how a lot of these large institutional investors are playing the world's second largest economy. So if you think about David Tepper of Appaloosa Management, he previously had said, buy everything China, right? That was kind of in the wake of that huge rally we saw in September. But actually, he trimmed his Alibaba holdings 5%, but that's still his largest holding.
Charlie Wells, brilliant as ever. Thank you very much indeed. The brief is up next. This is Bloomberg.